One of my next guests is a buyer of the regional banks here, even after the Moody's bank downgrades, even in light of the commercial real estate problems. Joining me is Mark Avallone, president of Potomac Wealth Advisors, along with CNBC contributor Jeff Kilburg, who's here on set with me. Welcome to you both. Mark, the KRE, I mean, oh man, just don't tell me it's leveraged.
Well, we talked about the KRE for the past 2 months, and it's had an amazing run. It's just up more than 15% in the past month. So it hasn't been a bad place to be. My thought on the regional banks is there's nothing new in this report. We are aware of the problem in office. We are aware of the higher cost of deposits, and that's legitimate. I think no sector is better poised for expense reduction and mergers than the banking sector. And it's the one area where even the Biden administration can get behind aggressive merger and cost-cutting activity because we're overbanked and it's long overdue. So as these pressures mount, we expect well-managed regionals to be adaptive and not stuck like a deer in the headlights.
Okay, so Jeff, I don't know if you've been dipping any toes in this area, or if you have any thoughts about the Moody's downgrade. Look, obviously the major averages are on taking on the chin today.
Well, I think first and foremost, Mark's right. They were late to the party. I think the rating agencies, by and large, they're archaic in nature. It's 2023. It's not 1983. So
they're still relied upon. Whatever all these firms we're talking to, and they say, well, I only invest in AAA, or I invest in BBB, or I invest. They're still used.
They are, but they're not as impactful as they used to be in yesteryear. So I look at the other side through the prism of trading. Yes, you're utilizing these rating agencies to help be more tactical, when to profit take, to Mark's point. But at the end of the day, I just don't think it's as impactful. Even look at what we saw with Fitch, back last month. So I think the rating agencies are a little bit overblown here, but there is reason here technically to understand. And Dom hit it earlier when you see this back and fill trying to get to this 50-day moving average. But the bigger picture, this banking sector, yes, you look at Bank of New York, you look at Truist, some of these names, they're getting hit on the chin today, but they've also had a nice little run. So this is volatility. You have to understand this is a higher beta sector, which is going to have more volatility as we see interest rates move in a historic manner up 500 basis points.
Is the market getting choppier? Let's look at the VIX. I know you know it better than anybody, and I'm thinking about Tom Lee's warning from a week or two ago as well about maybe it's going to be a little tougher slog here. Everyone knows we're heading into a historically kind of vulnerable time of the year.
It's a great question. You talk about volatility, and I am not wearing a red tie, so let's be clear. So I'm cautiously optimistic, but when you talk about the VIX, look at the VIX, which is measuring implied volatility. Those are the expectations for the S&P 500 for the next 30 days. Where we just came from, Kelly, the 52-week low in realized volatility, and this is a little wonky, but realized volatility is actually what the S&P 500 does on a day-to-day basis. So that was at 7. That means less than 40 basis points, or less than 0.5%. The market's been slowly moving. Last 3 trading sessions, we've seen the VIX above 16. Kissed 19 today. So now you're seeing expectations of these 1% moves, but this is not panic. We are not seeing people go out and buying protection. The trajectory moves higher, but I think this is actually very healthy consolidation when you see it come back down to its 50-day moving average after testing that 4,600 level, Kelly, which we talked a lot about being short-term resistance.
All right, so Mark, let's turn back to some of your picks. We mentioned the KRE, obviously. That's the fun one because it's so controversial and dramatic. Some of the others, though, I mean, you've got Apple, you've got Microsoft, Alphabet, NVIDIA, Oracle, Meta. Do those names ever come out of the portfolio?
No, I think they're here to stay. And I think since they make up part of the index in a big percentage, just about everybody owns them anyway. Look, each one has its own story. And I do like the fact that Apple and Microsoft have pulled back a little here. That straight line run up was causing concern. It might even continue. And that's going to create opportunities for value-minded investors to buy great companies at better prices. The story with Meta, and we haven't yet heard it, is we have an election year coming up, and it's going to be huge advertising dollars. Google will also benefit from that. Meta's had a huge year this year, and it's rebounded. But looking into the 2024 election cycle, I think we're going to break all sorts of records for ad spending, and they're both very well positioned.